My name is Matt Roberts. I'm a Stewardship Analyst at Fidelity International, and I'm here, as mentioned, to give the investor perspective on ESG and non-financial performance targets. And basically, so for the first part of the presentation, I'm going to talk about a little bit about Fidelity, how we look at companies, our investment beliefs, and how this translates into how we look at sustainability factors of the companies we invest in. And then in the second part, talk about how that then informs our view on ESG financial targets and in the context of our overall sort of philosophy around executive pay. Okay. So just a little bit on Fidelity. So Fidelity International is a privately owned, family-owned global investment and retirement savings business. Is global, based in 25 countries around the world with 2.7 million customers. We have a diverse range of clients of different types, so central banks, wealth funds, financial institutions, insurers, etc. We were established as the international arm of Fidelity Management and Research based out of Boston in the US. Today known as Fidelity Investments. We separated in 1980 and are now a separate business. So today we're mainly owned by senior management and the founding family interests, and with charities making up the balance. So we're a research-driven institution, primarily fundamental. In terms of investment beliefs, to sum it up, and this slide kind of sums it up a bit. So we believe that markets are only semi-efficient and that a long-term perspective on companies, their suppliers, markets, economies, etc., is critical. Therefore, we have a very large, exceptionally well-resourced global research team, which as of the end of last year was around 440 research professionals in total. So that included 123 portfolio managers and around 195 analysts, so that's across asset classes. So, and we think that this is important to have a large global team that collaborates with one another across geographies, across asset classes, so that we can understand the entire value chain and look at companies from a 360-degree perspective. So these beliefs and this structure informs our view on sustainability. So we view sustainability as a part of fundamental investing, and that sustainable factors are material to long-term value creation and investment outcomes. But sustainability factors vary by industry and geography and are therefore best understood in the context of local markets and business models. Therefore, moreover, sustainability is broader than just ESG and it includes sustainability of economic and financial systems. Therefore, we've taken the decision to integrate sustainability research into our mainstream investment research, meaning that our fundamental analysts are responsible for forming the house view on the sustainability characteristics of the companies that they cover, which I'll discuss in a bit further detail later. Furthermore, we're strong believers in the power and the responsibility, I guess, of asset managers and other investors to have a positive impact on the companies that they invest in. We're committed to exercising our ownership rights in a way that reduces investment risk over time and creates or influences positive corporate behavior. So the team I'm in is the Sustainable Investing team. We're responsible for stewardship activities, and we have subject matter experts in a variety of different areas across geographies, asset class, and various sustainability topics. So moving on. So this is a bit more about how we conduct sustainability research. I'll try not to get too down into the details, but basically, as mentioned, we've integrated it into our fundamental research, and it's helped us to address, not only is it sort of reflective of our belief, but it's also helped us to address some I guess, issues that we found with third-party ratings, and it's sort of, and I'll try to kind of tease out some of the differences in terms of how we look at that. So some of the issues, different views on materiality, as you may know, that there's sort of weak correlation between the different rating agencies giving different scores to companies and so forth. Diffuse ESG indicators, and a reliance on disclosures, which creates a backward-looking bias, and also it can create a bias in terms of large cap companies and developed markets and so forth. And we wanted to be able to take direction of travel into consideration as we would generally for a fundamental research perspective, looking at least 3 to 5 years ahead, if not more. This led us to design a framework which is differentiated in its forward-looking emphasis and use of our engagement with companies and the qualitative insights from the fundamental analysts as the main inputs. So this is kind of getting to the sort of differences in terms of how we this is from a client presentation basically, but sort of the differences in terms of how we conduct ESG research versus sort of third parties. And it's sort of, I think it sort of exemplifies the sort of differences in terms of how a long-term investor would look at it as opposed to a third-party advisor. So when you think about sort of the strengths of third-party ratings agencies, and they are, and we use them, and they absolutely play a very important role in investment. When you think about data aggregation, being able to present information in a standardized way, so ease of comparability, understanding of sustainability frameworks, best practices, standards, sort of knowing what good looks like being able to sort of set kind of benchmarks. And I think the difference that we try to bring is a couple of things. One, sort of having a more nuanced understanding of how different, we call them sort of sustainability factors, how they would affect the specific business model. So as opposed to looking at a sector and having a sort of idea of what factors should be important, looking at who the end clients are, what markets they operate in, whether it's differences in terms of the way of the governance and so forth. Also, on governance, sort of more of an insight, I guess, into the quality of the company's governance over ESG risks and in general, and sort of being able to, if there have been past issues, being able to put that into perspective maybe a bit more, I guess I should say. Understanding the constraints to realizing sustainability goals or targets due to various factors like the operating environment or client demand or the regulatory environment or other things. And then in general, just being able, as mentioned, to take trajectory into account. And the sort of the team that I sit in is, we try and provide almost the third-party perspective. So we have kind of, so for instance, we design the framework for ratings. We have sort of climate experts, supply chain experts, and governance and so forth. And then we can support the investment analysts, if they need a view on certain, what certain standards are or what, our house expectations are on certain things. But then, they provide the kind of individual company view or their perspective from covering the company. So moving on to the next section. This is the sort of, I won't go into too much detail, try not to go into too much detail on this, but this is sort of the like a high-level overview of our ESG rating, and so it's split into various parts. So we came out with our new, our second iteration of the ESG rating last year, and it's asset class agnostic, so we look at issuers. We don't look at, our equity and fixed income analysts work together to develop the ratings on individual companies. As mentioned, sort of the insights from our engagement are still the main input, although we integrate third-party data as well. The sort of question underpinning the overall sustainability rating, and this is something that the analysts have some discretion to adjust a little bit, is whether they consider that the company's management of ESG factors will materially act or detract from enterprise value over a 10-year horizon, which is a longer horizon than we would use for fundamental analysis, being 3 to 5 years. So in terms of our discussion today, there's a number of ways where this sort of framework helps us to assess ESG targets. So materiality being one of them, so just understanding what we would expect the material ESG factors to be for a subsector. seeing if there's any differences in terms of what the company's materiality mapping is, and then being able to have a conversation about that, maybe learning, maybe giving suggestions. Being sort of understanding what our view is in terms of whether there's scope for improvement on governance and management of ESG risks, for example, versus close peers, which helps us identify engagement targets and understand which issues the company should be targeting for improvement. And then, sort of understanding of the quality of management, which is something that we take into account also when thinking about ESG targets. So, how likely is management, how much do we trust them to deliver on this, and how much do we trust the board to hold management to account to actually deliver on the targets? And then views on executive REM in general, which is in the top right-hand corner, I think. But so because we of course look at the targets in the sort of context of the whole executive REM structure. So stewardship activities are led by the team I'm in, but we collaborate with the investment analysts. So when we engage with the company, so when we do a REM consultation, you're very likely to speak to somebody from my team, the equity analyst. We have a governance advisor, especially if it's a consultation or there's a chance that there would be some escalation, a voting issue or collaborative engagement or something like that. We try to engage in a consensual, sort of supportive manner. We don't sort of seek to, escalate in the first instance, but we will, if we have concerns about REM targets in general or ESG targets. We encourage companies to engage with us year-round. So we haven't stopped doing consultations like some other houses, which I won't mention. I did want to talk about Fidelity's just general approach to executive remuneration, and some of you may know that we had still have a very strong policy on the structure of incentives, and particularly the long-term share plan. So we were sort of very instrumental around the movement towards the 3+2 model that you see in the UK nowadays, so increasing the time horizon. And we took the view, and so this was derived from our investment beliefs and sort of the view that aligning management with equity owners and sort of instilling a long-term ownership mentality kind of trumped other factors. So, and the way that we kind of have applied the policy is not, I wouldn't go so far as to say it's been the only issue that we've voted on for executive REM, but it is by far the most important. And, it's meant that we've probably had a slightly idiosyncratic voting record, if you look back over the past few years, versus sort of other managers. And the reason I raise this is a few things which relate to what we're talking about today. So one, when we look at ESG targets and incentives generally, we think about a range of different factors, so structure, quantum, targets, outturns, discretion, etc. But targets play a secondary role to structure and share ownership, because our fundamental aim remains encouraging long-term share price exposure, which we think is most critical to instilling a sustainable ownership mindset in management. And we recognize also that there's certain situations where target setting may be difficult or inappropriate for some reason, and we recognize that it can create false incentives at some times. So this has sort of underpinned our openness to alternative remuneration structures, which, as you know, have been, we've seen quite a few of those lately. So when we engage on ESG incentives, it's in this context. That said, the time horizon over which many ESG risks manifest can be longer than an average executive's tenure, a transition risk being kind of a classic example for an affected business. And other important ESG factors are often not effectively priced into markets in the short to mid-term. So we do believe it's important to incorporate ESG and non-financial factors in some way. At this point, we're not very prescriptive in terms of how that's done because of our sort of support for, or I suppose, open-mindedness for different types of structures. We've seen a number of other asset managers adopt red lines around this. We haven't done that so far. Ultimately, we want to encourage quality target setting and not sort of a tick box approach. And yeah, the 5-year campaign has sort of showed us the sort of the possibilities of that sort of single-minded voting campaign, but also sort of the limitations on that as well. So getting to down to sort of the point of this all, sort of the things that we really look for in terms of a good ESG target is, this is kind of, talks about the things that we look for. So link to long-term strategy, societal impact, transparency, interaction with the financial targets, and appropriate weighting and integration into the REM structure. So in our view, ESG targets should always have a link to long-term strategy. The most compelling from an investor's perspective are those where they're based on opportunity, so where delivery is going to give the company a durable competitive advantage. So this might be where a company is a transition enabler or has targets linked to decarbonizing the business model, and that's particularly important for that company or that industry. In other cases, the ESG targets, they might be more about ensuring that the company executes on its strategy the right way, and as such reduces risks of eroding long-term returns, for example, to reputational harm, losing key talent, regulatory risk. So the board should have a clear idea of what category those fall into, because that has an influence on how that's sort of structured in. Boards should have a clear idea of who the company's key stakeholders are and how the company's activities impact upon them. Many asset managers will tell you that we're experiencing growing client demand to understand how portfolio holdings are making positive societal contributions, for example, aligned to the UN SDG goals and seeking to minimize harm from negative externalities. So we encourage companies to think about this and to consider sustainability targets through this lens. Targets should also be transparent and measurable. Notwithstanding the growing support that I think you've probably all seen for non-financial targets, there is still a lot of doubt in terms of how stretching and strong those are. And in my experience, when we do consultations, it tends to be that the targets haven't been set yet for the ESG side. The company might not even know what they wanted the targets even be on at that stage. That is improving, but I think lack of transparency around that can be a concern. Interaction with the financial targets, what I mean is sort of understanding whether, and this is related to the link to long-term strategy, the points I was making. So is there sort of harmony between the two, or is there tension? Tension isn't necessarily bad, but it's important for the board to understand whether you have a strategic ESG target, for example, requiring a lot of upfront investment from the company and then sort of a returns metric from the other side, or whether it's something that, where the sort of the financial and the non-financial are completely aligned. And then appropriate weighting, which I won't talk about too much. How am I doing for time? Do you know? Okay, a little over. Okay, I'll just wrap up with this one. So this is sort of an example of the sort of targets that we look for. And I should preface this by saying that this is obviously not a buy-sell recommendation, so please. Also, it's not sort of an endorsement of these companies' ESG strategies. It's more about sort of how the targets link to strategy. So probably hard to see, but the top one's Total Energies. So they're an oil major. They're going through a major portfolio diversification and decarbonization, and the targets are based around that. So you have Scope 1 and 2 emissions, so that's own emissions. Scope 3 in Europe, which is one of the stronger targets in the sector around that. And then you have organic cash break even, which is about another sort of part of the pivot to lower carbon portfolio. Includes focusing for the hydrocarbon part on cash generation as opposed to production volume, which was the earlier target. So they made a change, when they changed their strategy. So basically, you have ESG targets making up half of the LTIP, but but that's a case of where ESG incentives are targeting opportunity and competitive advantage, and where there's sort of harmony between the sort of financial and non-financial sides. The next one down, Origin Energy, another electricity company, Australian, we had a long engagement with them where they, again, sort of a portfolio diversification, which required a lot of upfront investment. And they wanted to move to a restricted share plan, which we supported very much, and we engaged on a few sort of share ownership bits and stuff like that. But with ESG underpins, the market wasn't really ready for it, so they ended up backing off that a bit, and they went with a sort of 50-50, which was approved in the end. But this is sort of a case where, so they had a ROCE target. They took that out because it was in conflict, basically, with the ESG strategy. So it was a case where, you had basically the board was conscious of the interaction between that financial and non-financial incentives and made an adjustment on that basis. And then the last one is sort of an example of where you have sort of, this was actually sort of Smurfit Kappa was sort of I asked one of our analysts what his favorite LTIP was with ESG targets, and he told me this one. It's sort of I guess basically a more mainstream example of where you have kind of balance between the financial and non-financial sides, and where it's maybe more about kind of doing good business.